Hi, welcome to the channel. My name is Edia. This is the Generation Invest YouTube channel. If you find intrinsic value in today's video, go ahead, like the button, push it, thumbs up, subscribe for more, click the notifications, and that way you can get more content from me. Thank you. Now today is going to be a bit of a doozy, so it's going to be quite long-winded. There's a lot to cover. So what we're going to be discussing in today's video, firstly, is what is the definition of intrinsic value, what we cannot calculate, understand owners' earnings, reveal the Krabby Patty formula and method, and value Google and Cannasouth. As always, it's important for me to offer a seamless and simplified solution when valuing a company or a stock. That being said, there are going to be other questions that you may have for me, or maybe something that I have explained you'd like me to clarify. Please leave them in the comment section below. Remember, there's no such thing as a silly question, and it could also help someone else in the community as well. That being said, let's start by defining intrinsic value. Investopedia says, intrinsic value is a measure of what an asset is worth. This measure is arrived at by means of an objective calculation or complex financial model, rather than using the currently trading market price of that asset. So it's by way of calculating the true value of a company or stock. Maybe that's why Plankton was so eager to get the formula. He just wanted to outperform the market. Well, Plankton buddy, if you're watching this, boy, do I have a few secrets for you. Now, when valuing a company, there will always be anomalies or outliers that we cannot account for, like consumer behavior or economic stress. There's also no economic number to tell us or identify how management will distribute cash flow. However, friend of the show Warren Buffett says it best. It's better to be approximately right than specifically wrong. He manages to consistently outperform the market because he thoroughly knows consumer behavior and which it operates, allowing more accuracy to his analysis compared to the common investor, historically. We need to find what our conservative growth rate is over a minimum of 10 years. In order to do this, we need to calculate how much we want to earn from the company over a 10-year period and work backwards and analyze on an annual basis what the growth rate needs to be in order to achieve this. I've mentioned it in my previous videos, the importance when investing in a company to invest in a company within your circle of competence or an industry you're familiar with. Now, it's critical because it helps you learn, understand, and analyze the opportunity for potential growth. Now, the number we want to focus on or grow is the amount of cash a company pays back to its owners or owners' earnings. Now, the card's in the corner if you haven't seen my previous video, but if you have, awesome, thank you. 2 points for Gryffindor. I explained an example of if I were to own a coffee shop, that after all expenses and bills are paid, so tax, wages, gas, electricity, cost of material, shipping, cost of production, everything, once it's all paid out, whatever's left over is the money that will go back to the owner or owner's earnings. And with that, let's crunch some numbers and finally reveal our secret formula. E plus D take away C. Reported earnings plus depreciation, depletion, amortization, take away maintenance, capital expenditure, and average annual amount expenditure, so plant and equipment, everything a company needs to maintain its long-term competitive advantage. If a company requires additional capital to maintain, this needs to be included. So E, earnings, plus D, depreciation, take away C, maintenance capex. Important when looking at a company's financials, they may just have capital expenditure, they may not break it down to maintenance capex and growth capex, and if that's the case, you will have to estimate the ratio between the two. By way of background, just giving you a better understanding why I chose Google and Cannasouth. Google is an American company. A lot of people are familiar with Google. It's traded on the US stock exchange, and you'll see shortly that Typically, there is a lot more information or resources available for you to find the numbers behind an American company. And Cannasouth, it is quite a hot topic, but it's also a New Zealand-owned company traded on the NZX, so a bit of Kiwiana. But yeah, the current market fluctuations over the past weeks or months, I want to find out if it's true to the numbers that reflect those changes or if it's something else. So what we need is a personal required rate of return, build in a margin of safety to allow for companies that don't meet expectations or even allow errors in our valuation. And 3 is discount the stock. So we need to work out what the stock value needs to be today in order for us to achieve our 10-year goal. So moving over to my computer now, I will open up a Google Doc. I know the irony. Label it stock valuation, put in Google, and the categories we want to calculate are EPS or earnings per share, growth, PE ratio or price per earning ratio, and required return. I then jump on Google and quickly Google the Wall Street Journal. Here I click on the little search bar and search Alphabet, which is the company that owns Google. I select that. I then scroll down to the overview, and here you will see earnings per share TTM or trailing 12 months is $44.84. I'll go back to my doc and add this. Now to calculate growth, I'll go back to Wall Street Journal, select financials, and then balance sheet. Scrolling down, select liabilities and shareholders equity at the bottom. There's a little plus logo there. And scrolling down to the very bottom, you'll see total equity. So total equity from 2015 is 120,331 and 2019 201,442. Go back to Google and search for the Casio calculator. The calculator will also be, there will be a link for that in the description below. So either search it through Google or just click on the link. Here we need to put in the present value, so that amount shown from 2015, 120,331, and then put in future value being 201,442. And then on the calculator we put in number of years being 4, so from 2015 to 2019. And this will then, we then select annually, and then this will then calculate the growth rate from 2015 to 2019, and we want to consider that same growth rate over the next 10 years. So I'll round this up to 14%. Now to work out PE ratio or price per earning ratio, I like to use MSN Money because that way we can get a better average. Selecting markets, search for Google, and once that loads, we then select analysis, and then price ratios, and then here we can see a PE ratio 5-year low and a 5-year high. So to find out the average, the simplest way is to add the two together. So 34.06 plus 23.91 equals divided by 2, and there's our PE ratio, 28.985. So we use that average just to be more on the conservative side. However, to be even more conservative, you can either use the PE ratio or multiply the growth by 2. Whichever is the lowest is what I use, so I would take away 1 to put it 28. Required return, typically over a 5-year period you want to look to double your money, but to be conservative you'd use a quadruple amount. So we'll double that to 10 years, and we want to make 8 times of what we invested. And again, this is extremely conservative, I know. However, it's better to have that margin of safety, which I mentioned earlier. So then I get the formula, and I know it looks quite intimidating, but once we go through it, you can understand that it's actually quite simple. So first, if you know your bed mass, you do the brackets first. So 1 plus growth, so 1 plus 0.14 equals 1.14. To the power of 10, if you've got this calculator, select the X with the Y symbol, and then then write in 10 equals, and then now that we've got that number, we then need to multiply it by the earnings per share, so times 44.84 equals this amount, and then we need to multiply it by the PE ratio, so multiply by 28 equals this amount. So this is the future price amount that we want to achieve after 10 years of investing in Google. You divide that by our required return, which again is very conservative, so divided by 8, we will get the best buy price, and that equals divided by 8, and that equals $582. Now you might be thinking immediately, well, we want to buy the stock for $582. It's currently worth $1,451. That's almost triple of what we want to buy it for. That may not be realistic, and I know. However, that's how you calculate intrinsic value. At the moment, the market is completely overvalued. So using these metrics may be difficult in order to find a company you would like to invest in at such a large margin of safety. Anyway, that's how you calculate intrinsic value for Google using my numbers and the way that I do it. Now let's copy and paste that down. Below that, take away the values and add Cannasouth. So first, Cannasouth is a New Zealand company. However, it was founded in 2018. So in order for me to find earnings per share, growth rate, or PE ratio, typically you would need to have the company trade for at least a minimum of 5 years. This will deem to be a lot more difficult. So if I just search Cannasouth in Wall Street Journal, it will come up with the stock. It'll show the stock price. Other than that though, there's really not much information that it gives you, again because it's only been on the market for less than 2 years. So there's no PE ratio, no EPS. Even if we look at their financials, there's no help. So because it was founded in 2018, the first annual report only showed 4-month period with no gross profit and a $245,000 loss, which is common for a startup company. The good signs in the financials is they have over $3 million in cash assets, and debt is relatively low in comparison at $278,000, giving a total equity of just over $3.1 million. Looking at the most recent annual financials now, which compare a 6-month period year on year. In 2020, they recorded a profit of $58,000 as they had started to make some sales. The total loss had increased, as I mentioned before, maintenance capital expenditure. In order for them to maintain their competitive growth, they had to pay things like research and development expenses and admin costs, which aren't cheap. Still in a green light, their total current assets, being cash as their main asset, had increased over the 12-month period. So again, more money for them to further invest. The liabilities had only changed slightly, up from $330,000 to $460,000, and total equity growth of an additional $4 million over the 12 months. So So that brings us back to our formula on our spreadsheet. I know it's nearing insanity to make such large assumptions, which can only be described as worse than speculating. However, for the purposes of this video, I'll replicate the above method given for Google against Cannasouth so that we have a number to work with. To do this, first we need to work out the ratio between the earnings per share and the share price. So to do that, you go 44.84, divide it by 1,451.02 equals 0.0309. So we'll then have to go back and put in 94 cents being the value of Cannasouth, divided by times 0.0309 equals almost 3 cents. So what this tells us is, based on using the same as above, we want to earn at least 3 cents per share. And then for growth, we'll use the same growth as above, so 14%. PE ratio will double the growth, so 28. And required return, we'll put in a multiplier of 8 for our 10-year growth. Copy and paste our formula and back onto the calculator. So again, we'll do brackets first. 1 plus 0.14 equals to the power of 10, because it's 10 years, times that by earnings per share, so 0.03, and then multiply that by the PE ratio, or price per earning ratio, to 8 equals, in 10 years time, we want Cannasouth to be valued at 3.11 or $3.11. Now to work out what the best buy price is now, we divide that by 8, and that equals 39 cents. Again, Cannasouth is worth 94 cents. We want to buy it at 39 cents. It is currently overvalued. However, I am using the same metrics as a global tech company, which is dubbed as one of the biggest companies in the world. So the ultra conservative nature of this analysis should be taken with a grain of salt. So that's the metrics I use when valuing a company. I've used the same method for over 3 years now. When I first started to have an interest in investing, well, the 2017 Bitcoin bonanza was the main purpose I stumbled across investing. Let me know your thoughts. I know there are a few flaws and a lot of speculation led by the examples I've given. Ultimately, I prefer to understand management and cash flow from financials as a stronger indication on company growth. Thank you if you made it this far. It is rare I would commit to a video this long, but hopefully the value I was able to add made up for it. Mā te wā!